I think cash, like normal cash, has a role. People underestimate the embedded optionality. In other words, if you have cash and things fall apart, you can pivot. If you're in private equity, for example, good luck getting your money back from Henry Kravis.
Right.
Great firm, but they're not going to give you your money back. So people, they don't sell what they want, they sell what they can. But if you have cash, you're the person who can look around, you can pivot quickly, you can go shopping in the wreckage. So that basically it's not the money call on every asset class in the world. That's valuable, and people underestimate the value of the optionality, number one. Number two, it reduces the volatility of the rest of your portfolio. So if you have stock, gold, real estate, and so forth, you can sleep a little better at night. It's the opposite of leverage, in other words. So I recommend some cash, maybe a big slug, maybe 30%.
The world is changing by the day on every facet. Put inflation aside, it's changing politically, right? Society's changing. There are so many changes happening right now on every level of this three-dimensional chess game that we play every day, that you'd be crazy to miss that. And so it just means you can't just wake up every morning and assume today's going to be like yesterday, because very slowly and very subtly, all our todays have been very different to our yesterdays for quite some time now, around the fringes. And gradually that's becoming more and more apparent to more and more investors. And they're doing something with their capital. They're making decisions, they're making adjustments, they're making changes to their portfolio. And eventually, the fact that today is constantly different to yesterday dawns on enough people that you get this sudden shift and everybody tries to get on the other side of the boat. And that's the thing you want to avoid. You want to make those decisions before that kind of that occurs to the majority of investors.
The scary thing though there, Adam, is deflation in asset prices while we have consumer price inflation. Is you have to understand that we're dealing with complex issues. It's not black and white, and you have to also understand we're dealing with cross currents that are at play at all times. So it's not whether we're going to have stock market crash or the stock market boom or whatever. It's these forces are at play constantly, like these tectonic plates, and we just have to figure out which one has the most power at any given time. And I think that's the prudent way to think through this, regardless of what the viewer's conclusion is.
Yeah, I hate to state the obvious, but sometimes the obvious is not so obvious, so I don't mind. The key is diversification, and everyone says, oh, of course, diversification. Actually, there's good, kind of empirical proof behind that. But the problem is people don't understand diversification. I run into people that go, oh, I'm highly diversified. I got 50 stocks in 10 different sectors. I got technology and consumer non-durables and all this. And I look at them and say, you're not diversified. You may have 50 stocks in 10 sectors, but you have one asset class. And that asset class has a conditional correlation in financial distress. They'll all go down together. So real diversification, have a slice of stocks by all means. Have some land, have some real estate. I like that. I recommend a big slug of cash, 30% for the reasons I mentioned. Have some alternatives. Got to be very selective, and some of the good funds aren't open, but there's room for that. A lot of my portfolio is not in publicly traded equities. It's in some technology startups, risky, but I find them very interesting. And gold. And I recommend a 10% slice for gold. I recommend physical gold because if you don't have it in safe storage, you don't actually own it. Most of what people call gold is paper gold. They're ETFs, they're gold futures, etc. And people love to put words in your mouth like Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's the end of the world, but I do think 10% is the right slice. But if you have that portfolio, 10% gold, 30% cash, 10, 20% real estate, 20% equities. I'm not doing the math in my head. I don't want to go past 100, but the point is that's real diversification with much lower correlation, even in distress.
There is no simple answer to this, and it's funny. When you have these conversations with people, they want to kind of skip to the end and ask for the recommendations. What should I do? What stock should I buy? What's going to make me money in this environment? And it just isn't that easy. It's been pretty easy over these last number of years because of all the things we talked about. The Fed put, the liquidity, the one-way direction of equity markets, the one-way direction of bond markets. It's been pretty easy, right? But when you get to these inflection points and you say, okay, suddenly everything's going to change. The Fed are going to be looking to taper. Rates are going to want to go up. Inflation is going to take over from deflation. Leverage is going to become problematic. There isn't a simple answer. There just isn't. As much as I'd love to give one to everybody, I wish I had a simple answer for myself. And that's where the importance of risk management comes in, because the risk that you've been having to deal with has been, as it turns out, pretty low over these last few years. So the amount of risk management you've had to do has also been pretty low. As the risks escalate, risk management goes up, and that's when people need help.